Well, hello and welcome to our Masterclass Budgeting for 2026, where we'll be discussing expert strategies for condo and HOA associations. Today, we'll be talking about a very important and timely topic that's top of mind for everyone. That is budgeting for your community. Homeowner and condo associations have experienced year-over-year changes. I know that might feel like it's happening every year, but this year is no different with economic and legislative changes that we're all facing. In today's session, we'll tackle a host of topics, including where to get started and what to expect for major components of your budget. What we've designed today's conversation to do is to bring simplicity and clarity as you tackle these major cornerstones of your financial plan. My name is Amy Sanchez, and I am the president of our Central Florida division. And today I will be moderating our masterclass. Before I introduce our panelists and get into the discussion, here are some things for you to keep in mind. If you have any questions throughout the session, please submit them through the Q&A option on your control panel. If we do not have the opportunity to address your questions today, we will be sure to have someone from our local team reach out to you. I too will be checking in on them as we go through this process. There is no need to take notes. We will be recording today's session and sending it to all attendees. In addition, we will be posting a very helpful budget checklist in the chat in the next few minutes. You'll want to bookmark this for the future referencing and be able to share it with others who might have interest in it. We've gotten great feedback about it over the years, and I hope you find it helpful as well. Okay, without further ado, we've got a great program slated for today, and I'd like to introduce Ilgam Hosea, who is a vice president on our team specializing in condominiums and high-rises. We have Brent Reynolds, vice president specializing in HOA and master plan communities, and Rob Huguette, who specializes in corporate finance and client accounting services. So, hello team, happy to have you here today.
Thank you, Amy. Great to be here.
Good afternoon, Amy.
Awesome. Well, without further ado, let's go ahead and get started. And I think it's important for us as we try to chew on this very meaty topic that's important to so many communities that we really start with the state of things. And every year, budget season tends to have a slightly different theme. So I would love to know, Brent, let's start with you. What are you hearing from board members and managers as they get prepared to start 2026 financial planning? Can't believe we're even talking about it already.
Right, already. Yeah, so one thing is for sure, associations have really been hit hard with significant changes and a lot of runaway cost over the past couple of years. So everybody's looking, kind of holding their breath, waiting for the collective release of breath, right? Are we going to have a little bit easier year in front of us? Particularly hit was the condo associations in Florida. Have really been reeling from the effects of the Surfside collapse and all of the very aggressive changes that we've seen in state statutes impacting them specifically around reserves and how to deal with that. But it also includes condos and homeowners associations all across the Southeast who've really seen some significant dramatic insurance increases as a result of a lot of extreme weather events that have happened over the past couple of years. So what's different and maybe a little bit of relief is for those associations who've done all of the things that they should have done in response to the impact of the last couple of years, we're sensing a little less pressure on budgets. And we think that we'll be able to really start to dial in on things that are a bit more of contemporary type of budgeting items to focus on. That said, I think everybody is still watching and waiting to see what's going to happen on a couple other headwinds that are really kind of unsure at the moment. For example, the economy. I think everybody's watching to see what's going to happen. Monetary policy obviously could have an impact on inflation over the next couple months. And the other one is those associations that maybe have some significant capital projects on the way, especially where building construction supplies are involved. Because they're going to face uncertainty on the pricing pressures that may come from the international tariffs that are abound. We've seen that in past years when we've had global inflationary problems and shipping problems. Those costs really go up. So this is kind of from my view. Ilgam, what are you seeing from your perspective?
Thank you, Brent. Those are definitely great points to point out. From 718 standpoint, we see definitely growing push for transparency when it comes to budget and rising assessments. Starting July 1st, a law states that the boards who want to raise the annual assessments more than 15% compared to the previous year's budgets must also have a backup budget, which without the non-essentials, in other terms, discretionary spendings. This backup budget must be also shared with the membership at least 14 days before and reviewed and presented at the budget meeting. What's also important to note that is how to calculate that 15%, right? That definitely excludes the major repairs and replacement or the structural integrity reserve study. So the bottom line is the new legislation means the board needs to plan and be more open about why assessments may need to go up even during uncertain economic times.
So what I heard from both of our main operators here is that, communities in general are better ahead this year than in previous years where we had to do some major lift and reserves to get structural changes that were made legislatively into place. So a little bit of relief there, but still economic uncertainty. And where needed, there is a little bit of relief potentially with the legislative changes and how to navigate that from a budget perspective. Rob, you have a different vantage point when it comes to overseeing really all of what funnels through our world and from a budget perspective. How do we as a team help to get prepared to help communities navigate through that? What do we do kind of behind the scenes, maybe a little peek at that and helping support our communities through this process?
Yeah, thanks, Amy. To follow up on some of the points that Brent and Ilgam brought up, it's really about the theme of planning and preparedness. They kind of both mentioned because while the external landscape, still feels a little uncertain, what sets us apart at First Service is our strength of our internal processes. We've built a strong quality control structure that's working quietly behind the scenes, but it's effective. Every financial plan that goes through a robust oversight, including oversight from CPAs. I myself, I'm a Florida CPA, and it's important that our managers are up to date on all the legislative and compliance standards that are out there in the markets today, and that causes the managers to sit down with the boards and be back with a full support of a system right behind them that ensures accuracy, compliance with new legislation, and also alignment with the latest requirements that Ilgam just brought up.
Yeah, I certainly can appreciate that if you're a manager or even a board, there have been so many changes over the last several years that having a team that specializes in understanding QA, quality assurance review, that I feel a lot more comfortable and confident as I go through this process.
Yeah, I want to add, Amy, that that proactive support, that's where it reflects First Service's depth in this industry, and our responsibility to lead.
Yeah, it certainly gives me more peace of mind too. So we talked a little bit about common themes. I suppose several on this call, managers and otherwise, are probably thinking, goodness, lots to do. Where do I even get started? And what should I be doing now to ensure that I have a successful planning season? Ilgam, can you maybe get us started on that?
Thank you, Amy. We can't believe we're already in July, right? The mid-year mark has passed. And the best practice is to start early and stay aligned. And how we achieve that, right? Starting early and creating those clear timelines. Let's work backwards, right? Establishing your budget approval date and preferably on or before November 15. We always say don't pass Halloween, but if you have to push the days a little bit, let's not pass November 15, right? And this will include your mail out first drafts, of course, mail out meetings, finance committee meetings, and board approval sessions. While you're doing that, aligning those practices through proactive communication with the community is essential. Let's engage early with the board and the stakeholders to align those goals, priorities, and expectations, and have those upfront conversations to eliminate surprises later in the process. by now, everybody should have opened up their budget templates and reviewing your contracts, right? Optimizing the services and reducing costs where feasible, while you're not compromising the quality of service is essential. And evaluating those variables and unpredictable expenses early, right? Pay close attention to those categories such as the utilities, insurance premiums, and any anticipated economic and market headwinds impacting the community, which we will be diving into later during our webinar. So make sure that you review your financials, current to actual, spot those trends and make real-time adjustments where you see it's needed. And educating ourselves, our boards, our managers, and all around on the regulatory changes. Let's provide those timely updates on the new laws, compliance requirements, and changes in financial governance, and keep the board informed to reduce risk and unexpected challenges down the road. What do you see, Brent, on your side?
Well, I think exactly the same thing, Ilgam, and I don't want your statement to go understated about getting started now. We hear from so many of our managers that are like, well, the board doesn't want to get started yet because they want to wait for this true cost to come in. They want to see what the insurance is going to be. They want to see this. There's nothing that stops you from starting your budget now. The tools that we use make it very easy for the managers to actually document on each line item what the assumptions were that went into the underlying numbers that are in place. There's always the opportunity to adjust as we go, but waiting too late in the process just adds anxiety. I think the other thing when we talk about simplicity here, really being the key point that we want to get across is budgeting in HOAs and condo is actually very simple, right? This is a business that is built upon expenses, and that determines what the assessments are going to be. So it's zero-based budgeting, right? We know what the costs are, or we have good assumptions of what they're going to be. We piece those together. That adds up to a total, and we divide it by the number of interests. We hear also from so many of our managers that it's like, well, we think maybe it's going to come in here, the assumption, but we're going to budget to the lower side. And I think the biggest advice that we would give is the dangers of under budgeting, right? It might feel good in the moment because you're able to go to your constituency and say, hey, great news, right? We're only going to see a 2%, 3%, 5%, 6% increase in the assessments. But the downside of that is finding yourself mid-year, your assumptions were wrong, happened to so many in the past 2 years with their insurance. And they found themselves not having enough money. They were insolvent to get through the year. And this is really painful. Having to do adjusted budget, having to do another mailer, which is very costly. It adds anxiety. It's unexpected expense for the community. So that's the painful route to go. Lean towards the higher side, even though that might not be the popular way to go, because it's much easier to deal with a surplus at the end of the year. We know how to do that. That's not painful. That can actually be a happy story. So that would be a key message when we say on simplicity is trying to manage down to dimes and quarters can really be something that sets you up for success, for failure, again, kind of mid-year or midstream in your budget.
Yeah, we're
So
already.
that Paul,
Go ahead, Ilgam.
to add to Brent's point, right, in regards to the surpluses, if you are on the conservative side and have those contingencies, then it can be returned to the membership either by issuing them credits or can be applied to future assessment. In turn, they will be receiving those, but you will have those eliminating the additional costs that you just listed.
Yeah.
Definitely good practice.
So much easier. So much easier to deal with.
That's right. We're already starting to get some questions in the chat around special assessments. And if we've got some time, we'll circle back to that specifically. But it does beg the question of, budgeting process is complex. It's not, it doesn't have to be complex, right? There are ways to bring simplicity to it. And so, Brent, my question to you would be, how can property managers and boards cut through the complexity to keep this process as clean and simple as possible? And you already spoke to some of that, but maybe expand on it.
Yeah, again, unless you're a very, very complex master plan community or very complex high-rise community, maybe with alternative businesses, food and beverage, things like that, it's really just blocking most of these expenses that the association deals with are non-discretionary, right? The utility bills have to be paid, insurance bills have to be paid. And I think in the most case, Ilgam already touched on it, is great managers have already started their budgets. They've opened them up. They're already collecting all of their contracts. They're looking to see what renewal terms look like. They're making calls. They're reaching out to the utility companies. They're reaching out to their vendors, and they're looking for budgetary advice. that they can lay in as the assumptions for what is going to shape the 2026 budget. So I think all in all, it's about getting started and not overcomplicating the fact that the business itself is actually fairly simple. And a little bit later, I think we'll probably get into talking about ways that maybe we can help to control those costs a little bit more, or maybe some alternatives that help to shave it off. But getting the fundamental budget built is actually just a block and tackle type of an approach. So not overthinking that, get the building blocks in place. Then you've got time to actually shape that budget a little bit more with some other alternatives.
Yeah, and it does sound like even when you are in a complex community or a relatively simplistic community, break it down into simple chunks that you can navigate. And kind of going back to what Ilgam had said in the very beginning, start with the end in mind, set the dates, work back to that, and then break up the budgeting process into
That's right.
chunks,
That's
right, that can be moved through.
I think one of the, Amy, I was going to say,
get simpler, right?
yeah, one of the benefits I was going to talk about too is our managers for service, because we manage so many communities, we've got a lot of benchmark data, right? So they don't have to be guessing and starting from scratch. So we provide them with local wage information, benchmarks on where we see wages going into the coming year. We pool our data on what's happening in the utility environment. And we work with our internal insurance consultants also, who are really collecting a lot of data. So we're able to really help shape that information early on for the boards and our local managers. So simple is better.
Brent, it's almost like you read my mind. Perfect segue to getting us into some of these big tranches. And, if I'm a property manager or board member right now, I'm thinking, okay, well, wages is a big chunk that I need to try to figure out for my community. What do we see? And maybe Ilgam, point this to you. What are wage trends that we see happening for 2026? And how can our communities and our managers start to prepare for that?
Thank you, Amy. Definitely the wages, not only for the on-site team, but from the service provider standpoint, and especially in the vendors, that is correct. Yes. In Florida, we all know that the final scheduled minimum wage hike to $15 an hour takes effect September 2025. Even if the communities are already in compliance, this will definitely impact 2026 budgets, as it drives the expectation across the board on the wage scale. As the minimum wage rises, so does the pressure to adjust those employees who are earning in the threshold of $16 to $18, which may also influence the salaried employees. Despite the signs of a broader economic slowing, wage increases are expected to continue to increase 5 to 6% annually or higher in communities with many hourly or entry-level employees. And boards should also treat wage increases with the same foresight and strategic planning for health insurance and liability coverage, right? And talent retention, that is essential. And competitive compensation becoming more and more important as labor markets tighten. Intentional wage adjustments may be necessary to ensure staff retention, continuity of service, and quality standards.
Yeah, so we hear a lot about, in Florida specifically, that final wage adjustments happening. I know it's natural for a lot of communities to say, well, we've already booked that in 2025. And I hope what everybody here takes away is that the somewhat trails in arrears, right? So that will go effect in September, but we will see it really pick up and influence the other wages that are close to that, put pressure on the hourly wages and the lower salary rates into 2026. So communities are going to want to prepare for that. Otherwise, they'll have steeper competition, right, when it comes to retaining talent in the new year. Well, we talked specifically about Florida, but Rob, I know you've got a broader vantage point. What are we seeing and thinking for some of the other states?
Yeah, thanks, Amy. Yes, Georgia and Tennessee, we haven't really seen the wage increases that we've noticed in Florida. So it's a little bit of a different story compared to Florida. Typically the 2 to 3% range is what we're seeing. We're not seeing the same level of compression that we're seeing in Florida as well. But one thing that, I want to underscore what Ilgam said is that, there's a human element here. These are the people that keep our communities running every day, and keeping experienced, reliable staff means, being intentional about the compensation. Otherwise, you find yourself paying more in the long run through turnover, retraining, and loss of service quality. But overall, the labor pool in both states, you know, as we see, there's becoming a limited supply of qualified, experienced workers. Even without the aggressive minimum wage, the demand for skilled labor, skilled members of our teams, especially around maintenance, administration, and on-site leadership, it's starting to outpace supply. So we are starting to see this wage increase starting to follow a little bit more slowly in Georgia and Tennessee than in Florida, but nonetheless an increase.
That's right. We're seeing more communities being created that are in associations and more high rises going up. And because of that, there's more demand for skilled labor in the industry across all the states, right? So great point for us to keep in mind. Now, wages, and you know, it's interesting we talk about wages, but Brent had mentioned earlier how economic changes are also part of the equation for this planning season. And so I think it's important to note here that wages are expected to potentially outpace economic growth, right? And so that's going to be something that we need to keep in mind as well.
Amy, to maybe just touch on that real quick, Amy, I think Rob sets a beautiful context there, right? People were like, well, when I look at my budget, these are all, I got to pay the utilities, I got to pay the insurance. What are the things that I can start to cut? And I hear often that maybe boards are looking to say, well, we're not going to budget for an increase in wages this year. Keeping in mind that the association is a wholehearted business and there is competition for great labor. And our experience has been that success in a community comes down to just like two basic things: having an aligned board with a clear vision for the community, and having a great management team on site who work really close in collaboration. So to the point, I don't know if many people know it, just in the state of Florida, there's 50,000 associations and about 9.5 million people living in those associations. So the whole point about competition for great labor to run these associations in an environment where we've got more and more savvy board members these days with much higher expectations and residents with higher expectations. So the quality of our talent on the front line is critically important. I think the other thing that's important here is we hear kind of, okay, some good rough ideas about where the South is with wages. The exceptions are really in the hyper local markets as we take a look. So great, state of Florida is done now. They've gotten to their $15, and we talked a little bit about the compression. Then when you zoom down into the micro markets, just using, because I'm in Orlando, we'll use this as an example. Disney still has a couple more years on their wage hike, right? Their union agreements take it up. So we've got increases coming through mid 2027 yet to still happen. And Disney's a huge employer, and they're in competition for people who are hospitality minded and want to work in the other parks. So Universal follows suit, SeaWorld follows suit, and anybody else who's pooling for that same talent pool, like we are a lot of times on our front line, compression's happening. The other impact is many of the southern states, right, are on the higher side of great increases in interstate migration, right? Central Florida, kind of in general, really seeing some huge increase in population, but that sounds like that's going to be great. That's going to help bring labor costs down, but ultimately we see them getting sucked up by new tech entering into this market, home growth, home builders, a lot of people taking that on, and warehousing labor demands, right? Amazon is massive here, lots of distribution centers. So that talent really gets absorbed in. So the summary here is, while Disney contracted rates continue through 2027, we're all kind of crossed fingers and hoping that maybe a little bit of a cooling in the economy will maybe help to temper that. But you have to know your individual local market from a labor standpoint. I hear about too many board members who will maybe go to their manager and say, well, I just Googled the average wage of somebody in maintenance in Florida, and it's this. And it's just like, that's just not really applicable in the micro market. That's where people work and live.
Right. No, it's a great point. And I'll go further to expand that to say it's not just the management team. It's also, going back to Ilgum said earlier, the vendors that support.
That's
so
right.
There's competition across the board for our landscapers, for even law firms and the teams that support them, elevator repair groups, right? The list goes on and on and on. And so because of that, costs are still going to continue to rise, particularly those that employ heavy staff. A next component for us, and Brent, you started to hit on it a little bit, insurance, which is a major component for most communities. We've had some big swings in our southern states over the past couple of years. Ilgam, getting started with you, your vantage point from a high-rise perspective, what are we seeing and expecting for 2026 in the insurance market?
Thank you, Amy. Insurance is a substantial part of our budgets, right? And I'd like to touch the South Florida high-rise and South Florida market in terms of insurance. What I'm about to share with all of you is based on the year-to-date trends and what's expected based on the broader analysis of our partners at First Service Financial brought to us. We are seeing year-to-date 15% rate reductions on an average, with some renewals coming even at below 40% on the expiring contracts. And we have renewed nearly half of the book of business, right? Because right before hurricane season, nobody wants to be renewing their policies during season. That has an additional impact potentially, and not one property experienced an increase. Rate reductions are driven by increased capacity due to more carriers entering to the South Florida market. And this is attributed to the new legislation, Senate bills passed that reformed and stabilized the insurance market, and properties being more proactive with their structural integrities, right? And risk assessments being underinsured. So 718 is bringing compliance on that as well, right? Ensuring the property values have full value. And now the TIV, total insurable values, and the assessments are coming back every 3 years as a mandatory. So those are important factors to look at. How to mitigate those risks, right? Always collaborate with your agents on the loss control and the walkthroughs of the properties, and point out those areas concerned that could potentially become a claim and prevent those. Roofs are a big factor, as we all know, affecting the property rates, and keeping maintenance records and implementing those maintenance programs are essential. Communication with your agent, again, regarding the potential claims, repairs, or any change to the property is key to be proactive. And now looking at how it's going to impact 2026, right? The sentiment in the market is that we're hoping for a quiet hurricane season. And we continue to see the rates reduction from 5 to 10%. And if we have an active hurricane season, rates may be affected depending on the loss run sustained among the carriers, whatnot. But essentially, we really won't know the real impact until we get through the storm season. So keep those lines of communication open with your agents, and follow the updates. And perhaps this is one of the line items in the budget to be last minute adjustment may be needed here and there.
Yeah, it does sound like a close connection with your agent and our First Service financial team. Really a smart idea, because while we've seen some relief this year because of the reserve improvements and things that communities are doing, as well as legislative changes that have brought more carriers into the market, still there are variables there that nobody's got a full crystal ball on. And so you want to be sensitive to where we don't want communities underfunding this line item and having to make special assessment adjustments in the new year. Brent, where's your take on this?
I think much of the same. I think I would just maybe color it a little bit with, again, down to that local level, right? That's where it's going to make a difference. So as you get up into maybe more of the crunchy middle of the state and up into the southern states, Georgia, Tennessee, obviously they've experienced impact from weather, and from place to place have experienced some insurance challenges. HOAs in general are almost always going to have a lower insurance burden because they don't insure as many assets as would be in a condo association, but they too can be impacted about where they're located, right? Being located in a catastrophe area, as insurance would call it, probably you're going to still see some increases, whereas those maybe being more inland that aren't in catastrophe, maybe being able to see some relief. I think you touched on the fact that there's more carriers now coming into the market specific to Florida. As you know, we had a mass exodus, and rightly so. With carriers coming back, the advice to managers and boards would be this would be a good year to maybe do some shopping. If you've not done that recently, maybe taking a look and really understanding, are there new opportunities for me? Are there new products out there that we haven't considered before, because there's new carriers with new products to actually offer for us?
Yeah, I continue to hear that when you get out of South Florida, who's experiencing the softening of the market, other markets are really starting to see, should plan for 8 to 10% increases is what we're hearing from our FirstService financial partners. That said, it really does come back to, Brent, your point, local area. Are you in high risk area? Have you had claims historically? So loud and proud message would be, make sure you're talking with your agent and getting that information, especially if the goal and your community's policy renews before hurricane season. That's a mid-year adjustment. So if you get it wrong, you're spending the second half of the year off plan. So make sure that you're dialing and asking those questions. Another big area for us to tackle is reserves, right? And so while it's been big for the state of Florida, it also has impacted Georgia and Tennessee. And this is a big thing that's on top of mind for most of our managers that are dialing in today, as well as the board members. And legislation has obviously made an impact on that. But I guess my question would be, what advice do we have for our boards who are still trying to figure out how to meet the funding requirements for reserve changes? Ilgam?
We strongly encourage our association managers and boards to review and ensure the capital reserve is accurate and up to date each year around this time. This is one of the most important decisions a board can make for future financial health of their association. An updated reserve study is an easy and effective way to ensure your community's capital replacement items are properly funded and minimal impact on unit owners. Why is this more critical than ever? There are a couple factors to that. The Community Associations Institute recently updated the capital reserve study standards. And as we all experienced, inflation and supply chain disruptions over the past few years have caused costs for certain components to rise as much as 50%. Having an updated reserve study is essential to reserve your community's financial health and avoid unexpected financial burdens, right? And there are some key factors and what's the benefit of these regular updates? Preserving and boosting property values, right, through those timely repairs and upkeep. And second one would be improving project planning and efficiency while minimizing those disruptions. And last but not least, preventing those large and unexpected assessments that can lead to resident dissatisfaction, right? What are boards for 2026 to know, right? Many communities have already made great progress in 2025 and are well positioned for 2026. So the boards that have completed milestone inspections might have the option by membership vote based on the most recent legislative update, right, to waive those fundings for 2 years. However, we strongly advise against reducing funding and recommend consulting with the association council, right, to ensure compliance. The clear recommendation is to keep moving with the full funding, and it's proven that communities that stay proactive and avoid future financial strain and maintain strong property values. Also, align your board's vision with the community's expectations, right? Delaying funding can cause larger challenges later, including, as we touched on earlier, special assessments. So boards who have that already conducted special assessment work closely with your engineer and reserve analyst to incorporate those funds into the overall reserve study and the structural integrity reserve study. From a high-rise standpoint, many communities have already implemented, so have less impacted because of the proper funding over the years. So these communities are now reaping those benefits. The bottom line is do what's right today, and you won't face difficult situations down the road. Pulling back on reserve funding now would lead to bigger problems later on. So one important update also as of July 1st is reserve account requirements for the deferred maintenance expenses exceeding 10,000. Now it's 25,000, right? So this is based on the inflation adjustments and determined by the DVPR, and also whichever one is greater. So make sure that you're in touch with your reserve analyst so those components are updated timely as well.
I think it's important for us to take a minute to back up here. A lot of what Ilgam has just shared is really pertaining to 718 condos that are subjected to the legislative changes around milestone inspections and their reserve, their Sears reporting and things like that. So what Ilgam shared on the time frame there is that yes, now you've got some room, goes from 10,000 to 25,000 if you're in a condo that, and again, condo is something that's governed by 718. But ultimately, our recommendation is to keep forward with the plan. So I suppose the spirit, at least that I pick up on, and Ilgam, Brent, feel free to chime in because Brent, I know you've got condos in your world as well. But the spirit that I pick up on is that the legislature wanted to offer opportunity for communities that were under too much pressure to make significant reserve changes. But if your community's already gone through that process, the goal here isn't to have you take a step back, right? It's to keep going forward. And the reality, and this is the honest truth, real estate assets, they're depreciating, right? Meaning that every year they get a little more wear and tear, and it's up to all of us to ensure that the communities continue to move forward. And so the purpose of reserves is to set aside the appropriate amount of money that makes sense, particularly for the structural stuff. And that's really what the legislature wanted to make sure that communities are doing. And then here's a little bit of relief if needed, though I think most of us have gotten past that curve is what I continue to hear. Brent, do you have any more color that you'd like to stack in there?
No, what I want to say is, first of all, to the board members out there who have navigated this and the property managers, thank you. Thank you on behalf of 9.5 million people who live in these associations, because this has not been easy. And keep going, to echo Ilgam over and over and over again. Look, the beauty of an association is that the value of a community is to be maintained in perpetuity, right, for its entire life cycle. And reserves are the simple way. Tuck a little bit away every year, so then when it comes time to have to make repairs, replacements, it's an unemotional decision. We're already funded. We take care of those things. So while it took something like Surfside to really kind of wake up the industry as a whole, what we found as we really got under the hood is that we were really underfunded. We were not making the right decisions on behalf of our associations. It's easy to defer a reserve. It's difficult then when it comes time to actually have to make the repair and there's no money. Then you have to face the association, the members as a whole, and then try to dig out of, how do we keep this up? So I don't want to be too much on a soapbox, but reserves are to be embraced as ways to invest in the health of our communities. And I think we all expected going into this year that the pendulum had swung really far, especially in Florida after Surfside, to almost oppressive, especially those associations maybe had not made the best decisions over the past 10, 20 years. And it's like, oh, okay, well, now we got to get fixed, but how do we do this? It didn't take a year to fix it. It's going to take more, it didn't take more than a year to create it. It's going to take more than a year to fix. So I think we saw some smart and welcome relief from the State House this year, not only on, some of the delays, potential delays, but also on making it easier for condo associations to actually secure funding, right? Now being able to use loans or lines of credit to be able to do it. Obviously on the HOA side, not to leave them out, everybody in HOA is going, it makes me dizzy just even trying to think about the condo world. HOAs, again, typically they're maintaining fewer assets out there, but it's just as important. A lot of times they're dealing with roads, sidewalks, lighting, clubhouse, all that are also things that if not maintained degrade. And I think we've all driven through them. We've all driven past them. And you're just like, well, I wouldn't buy there. So there's still the need to continue to invest. And if outside of Florida, so those of you in Tennessee and Georgia and Alabama who are like, okay, when do I get to hear something more? You better be watching your state houses, because I think, especially after a rough storm season, really thinking about and watching Florida is kind of now a slow motion story of what happens when we don't make good decisions, when we don't reserve, and legislators saying, you know what, maybe we ought to be taking a look at this as well. So if you're in a non-mandatory reserve state and you're a board member, the same impact implies, right? Maintaining your property is to playing a part in maintaining the home values of every member in that association. So whether mandatory or not, it's absolute best practice.
You bring up a good distinction here. We're getting a lot of questions in the Q&A section. The 15% from a budget perspective is specific to condos in the state of Florida. So getting a lot of questions on, does that also apply to HOAs, backup budgets? I think Jack asked the question, does that also apply to HOAs? And the answer to that is no, not as of this moment.
And the important thing there too, Amy, is that as Ilgam described, right, that is 50, it's basically 15% on operations, right? Because you can exclude certain items. So something really serious is going on if your operational budget is going to be going up by 15%. And we've seen it, right? And there can be some real reasons for that. But I would ask maybe everybody to take a collective breath. And, if you may see a 15% increase on your overall budget if you're still trying to catch up with reserves, but reserves are excluded from that 15% increase.
Yeah,
Great
and
to-
also I want to add also insurance, the reserves
Insurance.
that Brent and capital repairs are also excluded.
Yeah.
So really a very narrow lens on that 15%, giving some flexibility there. Brent, before we move to the next meaty piece, you said something that came to my mind that, a big part of what we do, and not just us, but anybody in this industry, managers, whatnot, we pay specific attention to property values, right? And the reality is that homeowners are, if we're being really real, homeowners are paying attention to reserves and what's set aside for communities as much as they're paying attention to special assessments. So if reserves are low, they're looking at that now informed and educated and saying, I could be subjected to a special assessment in the future. So we hear a lot of questions about, well, we're considering a special assessment, but we don't want to do that because it's going to impact homeowner values. And the answer back to that is, if you don't do it, you're still going to be hit by homeowner values because people are more educated than they have been in the past.
That's right, for sure.
Something to
For
keep in
sure.
mind. All this talk about big picture expenses, it's natural at this point for people to be saying, oh, well, we talk about a lot about costs, economy, big picture items. Where's there an opportunity to reduce costs? And where can communities really look at trimming expenses without sacrificing quality? Brent, maybe kick that to you first.
Yeah, I'll take a bite of that. That's the question everybody asks, right? And I think everybody comes into it with the expectation: how can we keep assessments flat? How can we reduce assessments? Which, in the reality of the world, there really isn't even a position we should ever really entertain, right? We see it in our own grocery carts, we see it in our gas tanks, and we know costs go up. And in any business, those costs are going to go up over time. I think, though, the other thing I would say is, given the massive increases in uncontrollable costs over the past couple of years, I think we have gone through every sofa cushion, looking for the change, right, that's fallen into the sofa. So I'd say that associations have done a really good job already of thinking about, how do we streamline the association? How do we control costs? That said, outside of the non-discretionary, there are, of course, some discretionary costs out there that associations should always be mindful of, and great managers are always looking at. I think a couple of those things would be to look to your legal fees. Are we using legal fees smartly? How much involvement do we need on things that we know how to do? So maybe that would be one area to take a look at. I think the other one is really thinking about the resident experience and where we're spending money today. I want to preface this is important. More and more, Amy, you pointed to a more savvy homeowner, right, who has expectations about the experience they're going to have in the community they're living in. So we are all about really curating a valuable lifestyle that means something, that not only creates a great life for your family, but also, again, adds value to the homes, right? I want to buy in a community where there is a sense of community and there are things going on that I like to do, golf communities, whatever those things might be. But I think it's about taking a smart look and saying, where are we spending those dollars today? Is it driving the very particular and value add lifestyle that we're looking to have here? But again, I just want to accentuate, residents have high expectations, and I think they're going up. And so investing smartly in that is what we would certainly advocate. But there may be some ways to shape in there or spend differently in order to get the same or a similar outcome in that experience.
Yeah, we certainly know that the reality is in this fast-paced day and age where everything is instant gratification, things like that. People don't want that when it comes to their home, to just be treated like a transaction, instant. People are really looking for their community to define what an experience looks like. We're hearing that a lot from new homeowners that are moving in that are saying, I want a community to not only feel like a community, but to be touched by the experience when I'm residing. When I call this place my home, it should feel different. And that sets a community apart from the next door community, right? So being able to balance that with cost is going to be a bigger focus for us.
Yeah. I would maybe want to set, before we go too much further, I know we'll talk more about some cost and maybe even some alternatives to that, to set context. And I hear a lot of boards think this way, right? And they start with, how can we cut cost? And I would just want to maybe flip the script on that just a little bit and think about, when people buy a home, for many people, that is the largest investment they're ever going to make in their lives. And they have an expectation of appreciation that's going to probably drive multi-generational wealth for their family. So they've got a very high expectation about what's it going to feel like while I live here? And then what's the value of this home going to be over time? And how does it continue to generate wealth? In fact, it's been the probably the greatest thing about the United States from a wealth building standpoint is home ownership, is real estate ownership. So we as association operators, right, both board members and managers, how we talk about this stuff, I think, is important. So if we replace costs with talk about how are we investing? How are we investing to improve and elevate the resident experience? How are we investing to actually really optimize the financial health of the association, but at the same time, optimizing the financial health of the homeowners who have bought in that community? Ilgan hit on it earlier, right? So it's about investments versus driving down costs. That makes us think a little bit differently and makes us think about how are we going to get the biggest bang out of whatever assessment dollar we're spending. And I would argue that savvy, to your point, Amy, savvy homeowners are thinking about it that way. And maybe some people who want costs to come down, but most are like, how are we taking care of my investment? And when we talk that way, people can get their heads wrapped around it, and we find a lot more support, which goes to continuing to communicate throughout this whole budget process.
Yep, that's right. So that kind of leads us into, like, I know we talked about expenses here, and a big part of that is a cautionary tale to make sure, you take some consideration into what you want your community to feel like before you get into that headspace, talk about and look at retention of property value, so on and so forth. But then reality is that there still is some space. Let's take a look at vendor by vendor, contract by contract, identify what is discretionary versus not discretionary, and then make sure that that's aligning with the goals and directions for the community, right? Overall in the field. And board members have a fiduciary responsibility to retain certain things, right? So it's not about splash, it's about maintaining what homeowners have bought into, right? So that does kind of lead us to, okay, well, we talked about these major components and expenses. How do we optimize revenue? Because that's a true opportunity, right? Homeowners are putting more in reserves. There's more money in bank accounts, for example. What should we be doing to optimize revenue for associations? Ilgam?
Amy, thank you. And Brent, both of you wrapped up the cost savings part tremendously. And there comes to a point when simply reducing expenses is no longer a viable long-term strategy, right? Essential costs such as utilities, insurance, and maintenance tend to increase annually, much like expenses we manage in our personal lives, to Brent's point. For communities, this means that maintaining financial health requires a broader approach than just cost cutting. To stay ahead of the rising expenses, associations should explore opportunities to optimize and diversify their revenue streams. One often overlooked is the area of performance of their existing funds, right? Such as reserve accounts. Rather than letting these funds sit idle, associations can work with strategic banking partners. We have our First Service Financial team always readily available there to assist us, our boards and our managers. So this way they can have interest-bearing accounts, investment options, complying with the governing documents of the association. That's an important point, and our team reviews that as well at every banking analysis opportunity that they have, and programs that will offer financial incentives to your community by focusing not just on cost cutting, but on improving the return on existing assets. Associations can create a more sustainable financial strategy that supports their long-term goals and obligations. That's what the theme, that one of the ones that we're seeing, optimizing the revenue part of it.
Thank you, Ilgam. And Rob, I would love to, I know we were kind of pushed through some expenses and revenue optimization. I know that this is a topic in particular that you're passionate about, always trying to inspire our teams to think about what else can we do for our communities from a revenue optimization perspective. What's your take on this?
Yeah, Amy, thanks. We do have other opportunities from cable programs and connectivity programs that we do partner with, and that's a really significant revenue stream for some associations, where we can partner with our connectivity group to come in and assess the value of putting a bundled program in place. Which really results in both a cost savings as well as a revenue opportunity for associations. So that's something that we partner with, like FFI, as Ilgam was saying, the banking. Those are really important keys, but also the other avenues that we have from a bundled cable approach. Those are great opportunities for revenue recognition.
So certainly, I think the large overarching message, and Brent, you're welcome to chime in too if you want, but the overarching message here is there is space for communities to take advantage of optimizing revenue. This is a category that you're going to want your managers to be exploring. And managers, if you're asking yourself, how can I get deeper into that? I would certainly be leaning into your regional directors to say, where do I have specific opportunity, and take their advice. The next big puzzle piece here is communication, and we're actually getting questions already. Some questions on how much communication should we do? What should that look like? I know I want to understand a little bit better from you all on what role, does proactive communication play in gaining homeowner support for budget decisions? But I have seen a couple of questions come in the chat as well that kind of add into that. Like, do we go as far as to show draft budgets up on the websites, things like that? So maybe Ilgam, if you can get us started high level, what's your take on communication? And then maybe we can get with some time a little bit more specific.
Yes, effective communication, right? For effective budget planning affects every homeowner. So clear and early communication, like we talked about earlier, are essential to build support and minimize frustration. Boards and our managers should incorporate budget updates in the regular monthly or at least quarterly meetings through reports from the treasurer, perhaps, and use a variety of communication channels, right? These can be your newsletters, email updates, or holding town hall meetings to manage those expectations and keep the community informed throughout the budgeting process. Consider forming a finance committee if you do not have it already to increase transparency and engagement. The committees not only bring diverse perspective, but also serve as the valuable liaisons within the community and can be your voice. Integrating budget workshops into your planning session and timeline is essential. These sessions offer homeowners the opportunity to ask the questions and better understand the reasoning why the financial decisions are being made in the manner they are. So understanding the why is essential through effective communication, and we find it very useful, especially with the town hall meetings, ironing out those questions from the unit owners, and they start talking to one another, and the boards gets more and more support.
So on that with communication, what I hear is that the reality is that Communication is key to a successful budget season process. And while it might look different for every community, transparency is consistent. It has to be consistent. So it doesn't matter what type of community, how you function, how you operate, you've got to be able to communicate. And then maybe the specifics get more specialized property by property. So there was a question that came in specifically about, should we share budget workshop, draft budgets, things like that? And I suppose the answer, if I go build off of Ilgam, what you said, would be it really depends by the community, but ultimately that the more communication with clear answers and reasons why and kind of what we're thinking about and what we're facing is always the right suggestion or answer, right? Brent or Rob, do you either feel passionate about
I
that?
think that's spot on, Amy. Just keeping this very, very simple here. What people really want to understand is, how does this impact me, right? So it's probably less about showing complicated spreadsheets that many people aren't going to be able to understand, but it's how we talk about the decisions that we're having to make, why we're making them. And again, words are important here, right? Where we're making investments and how that means that that's going to translate into homeowner value over time, I think are all things that just about having honest conversation, not necessarily about the spreadsheets, talking about the headwinds we're facing, talking about some of the initiatives we're working on to try to mitigate cost increases, are all things that people can understand, right? I think by and large, people are rational if they understand what's going on underneath it, but most people don't wake up in the morning thinking about HOA business, right? That's why there's boards and that's why there's management companies. And so it can get a little bit emotional around the time when we're talking about budgets, because people just don't understand, and that's okay.
Yeah, I really want to echo what everyone's saying. Is proactive communications really is not just a nice to have. It's really the most powerful tool that boards have to reduce resistance. Where we've seen success is where boards involve the homeowners through finance committees, the budget workshops that Ilgam brought up. These are the platforms not just for education, but for building advocacy and community support. It's great when you hear a neighbor explain why insurance costs are up, or why reserves matter in helping the healthiness of the community. It becomes much easier for when you involve people to get it's just much easier for the board to be able to communicate when there's a tough decision to be made. Involve the community members and over communicate.
Sage advice. So we're getting towards the top of the hour, but there are two questions that came in that I'd really like for us to be able to squeeze in if we can, and then would love to get your expert advice before we wrap. So the first one, in just a quick answer, and Rob, I'll aim this one to you. Health insurance, right? Also another big topic. We talked about property insurance earlier, but health insurance broadly, what are we seeing in the industry as we start to plan for 26?
Yeah, Amy, health insurance is definitely one of those budget drivers that can catch boards off guard. But we're still waiting final renewal figures for 2026. History tells us in the neighborhood of 7 to 12% would be a realistic range to plan for. And another point I do want to bring up is that and emphasize really is health insurance isn't just a line item; it's a retention tool also. So I want our associations to keep that in the back of their minds. In a competitive labor market that we see out in South Florida as well as in Orlando, offering good, decent coverage as First Service does become a differentiator in keeping good staff, and also which avoids constantly retraining individuals. So, although we don't know the number yet, 7 to 12 would be a realistic number to plan for right now.
And that's what we're hearing with other industry providers, as well as for those that are self-managed. So good takeaway, Rob. The next question, if we can quickly, Jimmy had asked, so what do we do in the event that a community has borrowed from operations or borrowed from reserves, meaning that they have paid out of their operations or reserves, it's owed to those bank accounts? Should the community plan for that in 2026 to be able to make those accounts whole? Anyone want to take that?
So that's a great question, right? And what those do-to-froms and how they generated is the foundation of the question, right? If you have where the expenses should have been coded, is it a true due-to-from, or is it but just simply making a miscoding of an expense, right? So if it is a due to from, then the funds should be returned to the respective funds, because we live on a budget, right? It's a zero budget line, and our expenses are to be subsidized by membership, and every fund should be within its own compartment. That's why the fund accounting is the essential for the 720 and the 718. And work with your managers, work with your CPAs, and also our great client accounting services system, right? The team members we have with the CPAs are here to assist. So we can take these questions offline and then assist Jimmy and the community more broader later on.
And what I hear is that, yes, we need to plan for that in 2026 to be able to get it where it needs to go. So great advice, Ilgam. So with that, because we've got this collection of experts on this call, and every budget season represents a year to continue to get better, what would be your words of advice, just short words of advice? Ilgam, I'll kick it to you first, as our teams and boards head into this year's budget season.
I think we've touched this numerous times throughout the webinar. Start early and communicate often. Successful budget adoption does not happen by accident, right? It requires proactive planning and consistent, transparent communication. Starting early gives our boards ample time to assess financial needs, gather input, and make informed decisions. Communicating frequently with homeowners throughout the process helps to build the trust and minimize confusion. Also, ensure alignment within the community's goals. Think it as a roadmap, and for a smoother process. And for all of you, for a step-by-step guide, please check our budget checklist, which is posted on the chat. And looking forward to a great 2026 budget season.
All right. Thank you, Ilgam. Brent, 10 seconds or less.
Yes, very short and sweet. Budget for the realities of the expenses that the association's likely to incur in the coming year. Don't under budget. That's never a good place to be.
And Rob, your advice.
Yeah, so I'm going to echo what Brent said earlier, is that plan today, protect tomorrow. The budget season isn't about covering next year's expenses. It's about setting the foundation. First Service is here to guide the boards through this process with structure, insight, and the communication tools. So yeah, plan today, protect tomorrow.
Right. Yeah. It's not just about 26, right? These communities are going to be here for decades to come. So let's do what's right as we go through that. So love that. Plan today, protect tomorrow. Well, that's all the time that we have today. Appreciate those that stuck around a little bit beyond the top of the hour with us. Ilgam, Rob, Brent, thank you so much for your expertise and your sage advice as we start to kick off the 2026 financial planning season. There's no doubt that based on your feedback, it takes thoughtful, insightful planning and action to make this the 2026 year successful, and you are helping us get started in the right foot. So thank you so much. Some housekeeping for any questions. Saw a lot come in that we were not able to get to. Please know that we will be following back with you. So appreciate your questions that have come in. And to our attendees, thank you for joining our masterclass, Budgeting for 2026, Expert Strategies for Condo and HOA Boards. We hope you found today's information helpful and you find ways to take what you've learned and put it to work in your community. Thank you so much for joining. Hope you have a great rest of your day.
Thank you, Amy. Take care.
Thank you.